We're going to do the first ever and maybe last ever, if you don't watch, version of Guess the House Price game coming up in just a bit. You got to see it. All right. Good evening here. Good afternoon out west, everybody. Happy Friday. I am Brian Sullivan. All right. First up on Last Call, the marvelous run for your money rolls on by a hair. The Dow 30 finished up today 0.01%, like Bluto's GPA. 2 points. But that was enough. It finished higher for the 10th straight session. The Dow, very quietly, now in one of the longest win streaks ever. Now, to be fair, the gains are not huge. The Dow is actually only up about 6% this year, but a pretty remarkable run nonetheless. And you can wow your friends this weekend with this stat. The longest win streak ever for the Dow was a lucky 13-day run back in 1987. So we are officially on record watch, at least for the Dow. The question, of course, is why? Especially with some growing concern about the economy and maybe a slowdown, stimulus money fading, student loan payments set to resume. And there's this matter of the interest rates being the highest they have been in years. Let's try to figure it all out. Talk about it with our A-list panel. That is Deepwater Managing Partner Gene Munster, Chief Market Strategist for StoneX, Kathryn Rooney Vera, and Big Tech founder and CNBC contributor Alex Kantrowitz. We've got Kate Rooney on later on in the show, Kathryn. So you pointed out we got two Kathryn Rooneys on the same show, on the same night. That's some sort of a good luck omen. The markets had some good luck. To what do you attribute some of this run that we've had?
Well, it's the luck of the Irish with the two Kate Rooneys, but
I love it.
The markets are the markets are certainly on a tear, and of course we know the breadth is very narrow. So this is a momentum-driven market move, and I think if we can play the market, we can continue to remain strong in or long in equities, but perhaps rotate out. Now is the time to rotate out of those overextended growth stocks led exclusively by the Magnificent Seven and tech. Yeah. And move into the cyclicals that will also benefit from this momentum, sentiment-driven, multiple expansion rally year to date, but have not yet done so. And I'm citing specifically materials and financials, for example.
Yeah, and Gene, this is the part of the show where some genius on Twitter is like, hey, man, nobody cares about the Dow. I get it. The Dow, no one's trading the Dow. I get that. But it is the thing that's in the headline of the local news, the local paper, the national news as well. And to Kathryn's point, Caterpillar is outperforming Microsoft or Apple in the last 12 months. I mean, you're kind of a tech guy, but even your cynical nature, Gene Munster, must be wowed by how some of these non-tech companies are doing.
I have been wowed, Brian, and I think ultimately we were too bearish at the beginning of the year, and as we've seen the economic data come in, along with a lot of investors, it's gotten us to be more optimistic. We don't want to play the momentum game. We want to look at ultimately what's most important, which is the fundamentals. And I would put this run in the Dow and the NASDAQ in very simple terms, is that over last year, we've been hyper-focused on interest rates. And as that hyper-focus to shift to a couple more rate hikes this year, and the lens focuses on next year, where we're going to see some probably the lack of rate hikes, they'll likely be steady. I think that is an opportunity for these tech stocks and the market more broadly to move higher in the near term. And so I'm optimistic. I want to have a critical eye to this, but all signs are for a soft landing.
Yeah. Michael, and by the way, apologies. I think I called you Alex earlier. We had an Alex Kantrowitz on a couple of days ago. I'm getting
brother
old.
From another mother.
Yeah, I turned 52. I've lost it. It's over. Anyway, I'm not sure I ever had it. Anyway, Michael, so my apologies on that. Listen, does technology have to participate? I mean, we all love, to Kathryn's point, the Magnificent Seven. If they falter, can the rest of the market do okay?
I mean, I guess if you define falter,
if they stay flat or turn down the rest of the year, can the S&P rise if they don't?
I think I'm trying to think what kind of macro backdrop would precipitate that, and probably one where inflation keeps coming down and the soft landing narrative persists. So yeah, it's possible. If the labor data does not further weaken and inflation comes down, I think that's exactly what you'll see.
Gene, I saw you shaking your head when I asked that question of Michael / Alex.
I want to make sure I got the question right. Can the market work without big tech
Can the
working?
S&P, here we go. In fact, I'm going to ask you all the same question. We'll put it on Twitter. Why not? Can the S&P 500 go up if Apple, Microsoft, and a couple of others do not?
My answer is no, no chance, not just because of the weightings, but just the psychological impact. What's beautiful about tech is it's about the future. It's about optimism that's inherent in the markets. And so ultimately, if the Magnificent Seven stumble, it's not only mathematically hard, but I think it has a contagion factor on the psychology of the broader market.
Kathryn, you agree?
I absolutely agree, but I think earnings have to meet expectations. So the soft landing is 100% discounted into the market. And I would put the probability on it actually not happening. So I would prefer to be defensively positioned in a market that's trading expensive, led by 7 stocks, primarily by tech, and has not yet broadened out. I think that's ripe for problems. And my suggestion, and what I'm advising our clients at StoneX, is to put on defensive positions, hedge your positions, buy cheap puts. The market is exuberant. There's a high level of complacency. So protect those long positions.
Yeah.
You can stay in the market and stay long risk, but this is the most overcrowded trade right now.
You guys are making me a little bit nervous, Michael, with this, to be honest with you. I mean, because if the market itself, the S&P 500, cannot go up 500 stocks unless 6 or 7 go up that have already gone up a lot and at some point will stop going up, that to me is almost an unhealthy market. I don't want 7 determining everything for 500. I know the NASDAQ, they reduced the weighting in the NASDAQ 100 of those stocks, Michael, from 56% to 44%, but they're still 44% of 100. That's how do we view that as not a negative?
Well, I mean, we cater to institutional investors, so the market weightings of these names don't matter as much. Obviously, if you're buying the index, that does matter. And so, I think if we think about why the market's up so much since October, and I agree with Kathryn, we've fully priced, I would say we've priced out all the inflation concerns from last year. On a number of metrics you can look at, the VIX is back to low double digits. Utilities has completely unwound all of its relative performance from last year. The PE of the market's back near 20. So we're back to levels we kind of were before people realized inflation wasn't transitory. So I do think that these bigger names are going to struggle to move higher, though I think they still have potential to do so because that's still where there's incremental earnings improvement. Yeah. And earnings is going to remain scarce. So, I would agree with Kathryn again that the defense, which has been left for dead in a market that's quite euphoric, looks pretty attractive on a relative basis, and no one likes it.
Yep. I once described the market as a bowling ball sort of balanced on top of a pencil, and now I'm a little bit more nervous than ever. Michael Kandritz, Kathryn Rooney Vera, and, of course, Gene Munster, thank you all very much.